Hello, everyone. Welcome to our discussion about the investment industry. And it is a pleasure to kick off this session on February 1st, on Year of the Tiger. Our first of many sessions like this, where we'll try to bring you together with industry practitioners and help you understand the real nuts and bolts and fundamentals that drive the business. I am Natasha Brzezinski-Mounier. I'm a trustee and co-chair of Girls Are Investors. And I'm so thrilled that we have today speakers that represent essentially every part of the value chain. The value chain consists of organizations that do different but complementary things. Investing involves allocating capital into productive businesses that will create value in the long term for savers. And that happens with a simple decision of an individual to start saving for their retirement or for buying a house. And you end up basically having pension funds and savings vehicles that are called asset owners. You also have asset owners that are organizations such as universities and countries. When a country is an asset owner, that's called a sovereign wealth fund. When a university is an asset owner, it's called an endowment. And so I will kick off our discussion by first asking Shivani to talk about her organization and how Oxford Endowment works and her background. And we'll basically go through each of the speakers' roles and functions, but also very importantly, as to what does their organization do, what is their purpose, and what is their mission in the investment value chain. We'll also take lots of questions. Feel free to start asking questions in the chat so that we can get to as many of you as we can. And so let's get going on this.
Great. Thank you, Natasha. And thanks everyone for joining today. Looking forward to the next hour and a half or so. So just a bit of background on myself. My name is Shivani. I graduated from Oxford about 5 years ago, and I currently work for the Oxford Endowment Fund, as Natasha just mentioned. So I'll give you a bit of background about what that actually means and what I do. So Oxford University gets donations every year from alumni or other charitable individuals or institutions, and that money builds up over time. But obviously, the important thing is that over the long term, that money is able to grow so that it funds research and education initiatives that Oxford University undertakes in the long term. So future generations will be able to receive grants and scholarships. Future research projects will be able to be completed if this pool of money grows over time. So what I do is I'm part of a small team that manages the university's endowment, which is currently about £5 billion. And we invest that into productive businesses, both public companies that can be traded on stock exchanges, and private companies, which are less able to be traded so easily, but more things like startups or companies that are experiencing rapid growth. So we buy those sorts of companies through fund managers. The purpose of all of this is to generate a return of about 5% or more each year in order to fund the long-term research and education initiatives of Oxford University. So I'm part of the team that makes those. I'm part of the team that is effectively stewarding the assets of Oxford University and investing those assets into productive businesses so that the university is able to have a sustainable and long-term future.
That's a fantastic start. So just to recap, the £5 billion endowment is looking to generate 5% annual returns, which funds the long-term research projects of the university. So your role in terms of stewardship is to make sure that the purpose of the organization is reflected in the kind of portfolio that you have.
Exactly, that's correct.
Right. And so you can invest in what kinds of assets?
So we invest in a mix of assets. Primarily, what we invest in is in companies. So the word that's used for that is equities. So it effectively means buying stakes of companies. But the way that we do that is through something called a fund manager. So we pick a fund manager, and the fund manager themselves chooses those companies. For example, on the public company side, public equity side, we might invest in a fund manager that invests in companies that you might know of, such as Google or Facebook or Tesla or companies like that. On the other side, we might invest in a fund manager that's backing private companies, so more emerging startup companies. Again, names that you might have heard of. Well, some of these might have gone public more recently, but things like Airbnb and Uber when they were young and starting out, backing companies like that as well. So we do a bit of both. And then we do also invest in some other assets as well. So for example, property, and also in credit, which I won't go into, but that's another what we call asset class as well. So we try and have a diversified portfolio that covers a lot of different asset classes, because for us that's the best way to generate our 5% return objective without having too much volatility during weaker periods.
That's great, Shivani. So essentially, you could say that what you do is allocate the funds to other funds. So you're sort of a fund of funds, and you allow other investment firms to make some decisions for you and diversify the risks of the portfolio so that in any given year, no matter if the market's up or down, you can get the 5% return.
Exactly. That's the goal. So we decide which of those fund managers to allocate to based on what we think has the potential to do really well over the long term, and then those fund managers in turn kind of execute their investment strategies and invest in companies in the kind of sectors or geographical regions that we expect.
Great. And just so you know, in terms of historical reference for the participants, equity markets over the very long term, generally return something like 6 or 7% per year. But in any given year, you could have a major drawdown, which is a sell-off. And that means your capital is at risk, which is why for an endowment like Shivani's, when you want to have a fairly smooth return curve, you need to have more diversification and other kinds of investments that are not just equity markets, even if equity markets over time may deliver higher returns than the 5% they seek. So keep that in mind. We'll come back to this later on. But now I'd love to move on to Bertie Pommier, who represents a fund manager. And why don't you tell us about what you do and the purpose of the organization and how it fits into this sort of chain of value creating businesses that form the investment world.
Absolutely. Thanks, Natasha. So hi, everyone. My name is Bertie, and I originally come from France, but moved to London about 3 years ago. And I work for a company called Heitman, which is a fund manager, like Shivani just referenced. So someone like the Oxford Endowment Fund or pension funds or sovereign wealth funds will give us money and will put us in charge to invest it and create returns on their behalf, basically. So Heitman focuses on real estate only. We basically just invest in properties, manage them, sell them, and try to create value along the way for our investors. So our firm was established in 1966. It's headquartered in the US, and we have a small team in Europe, about 50 people versus about 400 people in Chicago. So it is a big firm. We manage over 51 billion US dollars overall right now. So it is a big firm. In Europe specifically, we focus on 4 different sectors, which are residential sectors. So we would buy a block of apartments, for example. We also invest in senior housing, mainly care homes. student housing as well, and self-storage facilities. And we invest across Europe. The strongest markets right now that we find are the UK, Ireland, Germany, the Netherlands, and France. So that's where our assets are located at the moment. But we might, you know, when a new fund opens, we might explore other geographies. We used to be in Eastern Europe, so we have a very strong research team that basically tells us where the strongest markets are. So my job is, as part of the investment team, is to source deals, so source transactions. So agents will come to us, show us a property, and ask us whether we want to buy it. So we will do our research, we will analyze the investment, we will run all of our numbers, and then we will run that past our fund managers. And once, so the fund manager, meaning in our team, the people who are responsible for the fund and its performance. And once that's done, we're going to do a full load of due diligence on the asset. So that means checking that everything is in order with the asset in terms of legals, in terms of technical, environmental issues, everything. And then once everything is sorted, we will buy the asset. We will hold it for, say, 5 years, 7 years. Through those 5 or 7 years, we'll try to add a lot of value. So by, for example, refurbishing old apartments, or creating energy efficiency improvements, or, you know, converting the building. So say converting an office into residential, or, you know, create as much value as we can before we sell it to another investor typically. So that's, yeah, about what we do.
That's a great overview. Now, the 5 to 7 year time horizon, is that something that your firm just decided to do, or is that sort of the real estate market cycle?
I would say it's about typical in the real estate market, but again, there's assets that we will hold for 3 years because we find that the markets just performed extremely well, and we think that, you know, the returns we're able to realize at this point in time are so much higher than we could a few years down the line. But we typically analyze an investment based on a 5 or 7 year hold period. But again, we regularly analyze whether it's worth selling or holding.
That's super interesting because, as you probably know, the equity markets traditionally had a market cycle of about 5 to 7 years. But then the last 10, 11 years, we've had what's called a super cycle. And in that sense, a lot of other kinds of investments became correlated to equity markets. And because shares were doing so well, some other asset classes were doing well. There's even now a theory that a lot of crypto assets, you know, were sort of fueled by the equity rise, especially over the last couple of years. But it's interesting to hear that the general practice in real estate is also this 5 to 7 year horizon. And real estate has historically always been considered sort of the inflation-proof asset class. So it's particularly useful for endowments and pension funds to diversify their risks from assets that are very sensitive to inflation, like bonds.
Yeah, exactly. The whole goal of holding real estate is to gain income, and rents tend to rise with inflation, and that's why we call it an inflation hedge in general.
Right. When you invest in real estate, that's something like residential housing and student housing or care homes, you could call it even an annuity. An annuity is something that pays you predictable streams of cash flow year in and year out, and it can go up with inflation, unlike bond coupons, which don't. So that's an important thing for our audience to keep in mind of why this is so important when you think about your personal savings, but also about how the value chain of investing works in our industry. So let me now turn to Tara. Tara Jameson, who can tell us about other kinds of assets and investments that your firm makes.
Absolutely. Hi, everyone. I'm Tara Jameson, and I work for a company which is called Schroders. It's also a fund manager. People sometimes call fund managers asset managers. So if you hear the two things, they're the same thing in the industry. And so similarly to what Bertil said, you know, we manage assets on behalf of other people. I think probably the key difference is that Schroders, being a very large asset manager, means that it typically covers a lot of different types of investments. And within our company, we would similarly have a property team that will look specifically at property. And we'll also have teams that look specifically at owning shares in companies, and teams that look at investing in bonds. What my team does at Schroders, we're called the multi-asset team. So I'm a portfolio manager on the multi-asset team. And I think what I'll try to explain to you is what multi-asset actually means in the industry, because if I try to kind of cast it back to first principles, and I was actually thinking yesterday, what even is an asset class? I actually had to Google this, and I got myself onto, I mean, I'm a multi-asset portfolio manager and I didn't know what the definition of an asset class was, but I went on to Investopedia, which, by the way, should be all of your best friends, and never feel ashamed to use Investopedia. I am 7 or 8 years into my career and I still use it pretty much every day. So please get on there. So an asset class, according to Investopedia, is a collection of assets that share similar financial characteristics. And I think it's quite an important concept actually for people to grasp before you go into the investment industry. And it's probably something I wish I'd known before I went into the industry. Because if I cast my mind back to when I was probably at a similar stage to a lot of you at school or university, and I was starting to look at investment firms, I was interested in the industry, and I thought I knew quite a lot about it. But actually, I want to dispel a misconception that I had at the time. I don't know if any of you share this, but I thought that all investors were stock pickers. And I thought that every investor's job was to look very closely at individual companies and essentially to decide whether to buy a portion of that company in the form of a stock or a share. That's not untrue. That is what a lot of investors do. But what I want to try to share with you today is the fact that that is just one type of asset. So stocks and shares, we've already mentioned today, make up the equity asset class. But there's a lot of other types of investments as well. And we've referenced bonds already today. Bonds are effectively an IOU. So if I buy a bond, I am effectively lending someone money, and they are making a commitment to pay me interest payments on that loan, or whatever you want to call it, and to pay me back the amount that I've lent them when that bond expires. So that's another example of an asset class. And the other two main ones I tend to look at are commodities. So if you think about oil and gold are probably your most common examples. And then also every currency around the world. So what's our currency worth against the US dollar? Or what's the Japanese yen worth against the Swiss franc? So these are all the kinds of collections of assets that form asset classes. And I said in the definition that an asset class is defined as a collection of assets that share similar financial characteristics. And because they share similar financial characteristics, they tend to behave as a collective. Each asset class will, an asset within an asset class will behave similarly to the other assets in its asset class in a particular economic environment. But that collective will perform quite differently from a different collection of assets in a different asset class. So equities, we said, that's the shares of companies. They tend to do very well when the economy is incredibly strong. Whereas bonds, the IOUs, are pretty steady assets, and they tend to do much better when the economy isn't faring so well. So coming back to what a multi-asset investor is, it's basically my job to run portfolios that invest in assets across all asset classes. But I'm less interested in exactly which company I'm choosing, and I'm more interested in how I'm allocating between those asset classes that we know behave very differently from each other, depending on the economic environment. So if I think about it practically, and I kind of compare myself to what I thought that every investor did, so your traditional stock picking investor will spend most of their time looking at what we would call bottom-up microeconomics. So what does that specific company do? How are they generating profits? How are they building their market share? Whereas what I do is spend most of my time looking at macroeconomics. So I'm coming from the top and I'm saying, what does the outlook for growth in the global economy look like? What does inflation look like? And how do I think that's going to evolve going forward? And that's what determines my investment decisions between those asset classes.
Tara, that's brilliant. What sort of time frame do you use when you make those decisions about the portfolios?
Very good question. So we actually use a mixture because what we like to do is have a longer term, we call it actually a strategic allocation. So we have, you've referenced already that the expected returns from equities, if you look at the past, are much higher than other asset classes, but they also bring with them a much higher level of risk. So we set what we call a strategic allocation, which is what we think over the longish term, so probably thinking 3 to 5 years, is a sensible mix of those asset classes to try to deliver what our client wants. So in the case of Shivani, we'd be looking at that 5% return and thinking about what mix do we need to have to try to meet that over the long term. But then we know that markets move quite rapidly in the shorter term as well. So we do what we call tactical asset allocation, which is where we do small adjustments around the edges to our strategic allocation, depending on the market environment at the time. So the time frame for that could be anything from a month to probably maximum a year we'd be looking at when we're making those decisions. But as I say, they're sort of smaller decisions around the edges rather than the strategic allocation, which is obviously a very big driver of returns.
Right. So you have some surgical strikes, and then you have some longer operations.
Yeah.
And it's really, really helpful that you referenced so many useful tools for our audience, including Investopedia. And I think it's actually amazing. I hadn't thought of it before, but we have the £5 billion endowment. We have the 51 billion real estate manager and the 550 billion pound multi-asset manager. And before we move to Ollie, let me just say a few words as an equity investor, so that I sort of maybe fill out a bit the mosaic on what active equity investors do and what passive equity investors do, because they're such a big part of the investment sort of the granularity of the investment world. So much of it is driven by equity. I spent almost 20 years at Capital Group, which is a very large investment firm that many people have not heard of in the UK. It's a US-based firm, and the assets under management currently are $2.5 trillion. I started there in '96 as an emerging market analyst, and at that time we covered countries, not even sectors. We covered the countries that we generally spoke the language of, and I spoke Russian. I was born in the Soviet Union, so I covered Russia, and then I covered Eastern Europe, and then parts of other emerging markets in Africa and the Middle East. But then really through the 2000s, we shifted coverage to sectors. And so I became more specialized in understanding how certain industries work. And this is more common to how active equity coverage is built today. Fixed income investors, especially the ones that cover sovereign country-based bonds, they still focus on geographies. But corporate bond investors and equity analysts will focus more on sectors. And so my responsibilities were to identify the companies that are going to be relative winners in their industries. And the industries I focused on were telecommunications, media, consumer, a variety of sectors within a geography that was called EMEA at the time. Now it's a bit bigger. And that made me really a specialist in understanding the business models and the path to success for companies in a given sector. And in an active fund, your mission is to identify a company that's going to be the Tesla, or the Nike of their peer group, and buy that stock, sit on it, don't budge, and grow that value and experience the eighth wonder of the world, compounding for as long as possible. And that's what active managers do. Passive managers will look at a combination of indices, to gain exposure to a theme or to gain exposure to a geography or gain exposure to a sector. And instead of saying, hey, Tesla is really the one I want to focus on, you could say, I think the automotive industry is going through a big shift, and I think it's going to be exciting, and innovation is going to create value. So I want exposure to the whole sector. So that's very broadly sort of the difference of active and passive and what the analyst roles mean in that context. Now let's move over to Ollie. I'm so happy that we have a gentleman with us who's spending time to discuss the career path and the role that you have in making connecting the client to the investment process and sort of being the bridge between those very important stakeholders. So essentially, you're the bridge back to Shivani.
Yeah, that's right. So look, welcome everyone, and thank you, Natasha, for the kind intro. It's great to be here this evening, speaking to all of you. Absolute pleasure. So as Natasha said, my name is Oliver Leach. You can call me Ollie if you've got any questions, and I do compel you to ask questions because I think it's really important, and we've got some amazing people on the call tonight. So no matter what that question is, and I know myself when I joined my first company, I asked so many questions and I felt so stupid, I would say, for probably the first 6 months. So please do ask questions and don't be afraid to do so. As Natasha said, I'm responsible for basically connecting our end clients to the funds that we run at my company. My company is called PineBridge Investments. It's a private global fund manager. So we've come across that term already this evening. I'm based here in London. And my clients range from the likes of a private bank, or let's just call it a bank, asset managers, fund managers, wealth managers, and family offices. So it's very much in the wealth space. I've been working for around 3 years in finance. I've been working for PineBridge for about 3 years and in finance for 12. To give you some kind of context of where PineBridge sits in the value chain, we run about 140 billion across all the different asset classes. So unlike Batil and at Heitman, we focus on all the different asset classes as we've kind of touched on today. So that 140 billion that I mentioned is split across fixed income or bonds, so IOUs, as Tara said, equities, shares in companies, multi-asset, as Tara again explained. I thought she did a great job. So let's call that the spectrum of asset classes. And then alternatives, things like real estate, private equity, venture capital. My core responsibility is going out and finding money, pulling that money back to PineBridge, and then we invest it in the market. So we invest it in those markets I've just mentioned. Now, it's quite interesting because Shivani works for, prospectively, a client of mine. And these clients, or these people that I speak to, there's not just one type, there's lots of types of different clients. So to give you an idea of how many people that we could speak to, we have individual corporates, pension funds, insurance funds, sovereign wealth funds, endowments, charities, intermediaries. Now, I typically focus on one of those. And I would say in most companies like a PineBridge, there'll be individuals that focus on one of those segments. Now, there is a lot there. There's a lot of terminology there, but these are quite common terms within finance. I think it's really, really important, and I actually think, Natasha, you've done a great job putting everyone together tonight, because there is a value chain here. And when we speak about value chain, what we mean is the connection between the end investor and who is placing that money into the market. Now, can be a very long chain. It can be, you can look at it right from the individual, like maybe your parents or myself or the other people on this call. They put that money into perhaps a fund, or they give it to a wealth manager. And that chain is from that money all the way to the individual companies or bonds. And so it is a really, really long, or it can be a really, really long chain. I think that might be enough for me, but I would say, honestly, just ask as many questions as you can. Don't be afraid of terminology, because everyone felt the same as you do now, or perhaps you do. Certainly when I joined my first firm back in 2010, I spent so much time on Investopedia. It was quite incredible, almost to the point where I wondered whether I'd actually had a degree. Do ask questions, don't be scared of it. And the terminology that you'll hear perhaps today or in a textbook or in a lecture, it gets easier as you go along. And I think there's only one solution for that, and that is time, questions, and spending time at your company or in the market. Back to you, Natasha.
That's great. Thank you so much. Maybe you can also tell us, what sort of time horizons do your clients have?
Yeah, of course. So I think it's very interesting as working in what I do, so raising money, that we will, I suppose, typically speak to lots of different clients in investing in lots of different asset classes. I would say, depending on the asset class, the client will have different time horizons. I think probably the longest that we deal with is the more private alternative space, I think. And so this is going back to what Bertel said in maybe real estate or private equity real estate or private equity. I think really the time horizon there is 10 years, something like that. Let's say 7 to 10 years. I think typically it's shorter in equities, but having said that, we have investment managers and portfolio managers that have bought a company 20 years ago and they still invest in it today. So I think it's hard. It's a hard question to ask. It's a good question to ask, but the time horizon can change a lot. It can change on asset class. It can change on what that client is using that investment for. If you speak to an endowment, or a pension fund, the time horizon could be kind of 20 years. It just depends, and I think it's probably a hard question to ask. There's lots of answers for it.
Well, I asked it for a very specific reason. I think it's really important to understand that there is a variety of time horizons and a diversity of needs in the industry, which is why it's so tricky sometimes to get everyone on board as to what the long-term means and what are the trade-offs of the short-term versus the long-term. And an example of that, and I'm sure we'll come back to it with Q&A, is when we talk about ESG and sustainable investing, because these are very long-term undertakings. And in the short term, you can only, sort of do so much or get so much. And maybe that's fine for certain kinds of investors. And for others, there's a longer term horizon. There's a sort of a patience curve, but there's not really a one size fits all when it comes to investing in general, but specifically when we talk about ESG and some of the, newer ways to invest sustainably. So thank you very much for all these very foundational, important comments. There are a couple of questions in the chat that I will get to right now before I move on with our line of questions, the ones that we had sort of planned to discuss. I think these are really good questions. So let me first go to Victoria from King's College. And she asks Tara, but I think everyone should actually answer this question. How do you stay on top of the news flow? There's so much going on. Does your company pay other people to provide advice and insight? Do you read a lot, or do you just not sleep? How do you stay on top of the news that matters to you? So we'll start with Tara, and then I'd love everyone else to comment as well.
Yeah, I mean, I'd actually really love to hear everyone else's thoughts on this question as well. It's always a very interesting thing. The question you asked at the end, do I sleep? Yes, I definitely do sleep. And actually, I think something that I didn't necessarily know before I joined the asset management industry, but if I had known it, it would have really encouraged me to join it, is that the culture and the work-life balance that you get in asset management is an absolute dream compared to a lot of other jobs in finance. So that's a secret that I think a lot of people keep, but should be more widely known. But in terms of staying on top of all the news flow and work, I mean, I'm very lucky that I work for a very big asset manager. And yeah, multi-asset must sound like I need to know everything about every asset that ever exists on the planet. And yes, we do to a certain extent, but we are also a global team. So if you think about the multi-asset department at Schroders, we've got people on the ground in New York all the way around to Sydney. And we basically divide ourselves between the different asset classes, and we share our research very dynamically between each other. So we almost divvy up the world and give each other specific areas of focus and responsibility, and then we trust each other's research. We challenge it, but we debate it and come to a consensus view on everything together. So I'm not having to cover absolutely everything myself. What I do cover specifically is more looking at credit, which I know Shivani mentioned, and credit's probably another foreign word to you at this stage, but it's effectively when you lend a company money. So instead of buying a portion of that company, you lend them money, and they promise to pay you interest payments and give you back your money. The risk is obviously that the company goes bust and never pays you back. So that's the trade-off you have to try to judge. But in terms of, obviously as a multi-asset portfolio manager, I do have to take decisions on combining everyone's views on different asset classes and exactly what I'm going to choose to do in my portfolio. So I do have to have an awareness of the global economy and the major news flow. Yes, I do read a lot. That's a big part of the job, I think, with investing, is reading information, assimilating it and processing it. And I think a big challenge that and a skill that you have to try to learn as an investor is to try to siphon through all the information to find what's valuable. You cannot read everything. So that's almost a skill that you kind of have to learn on the job. But I think the final thing you asked in that question was, do we pay other people to provide us with research? And yes, we absolutely do. We pay the big banks, so people like Goldman Sachs, JP Morgan. They all have big departments who are analysing the markets in minute detail, and they write very comprehensive reports on things, so we read those. And there are also companies, which I guess we would say are also in the value chain, who don't run money, but they are called independent research firms. They're not attached to a bank, but they have a very close eye on the market, and similarly, they provide their views and analysis. So we speak to them, we have meetings with them, and we read content from them as well.
Thank you very much, Tara. Just a quick follow-up question was to elaborate on the culture and work-life balance.
Yeah. Well, I think the advantage of being an asset manager or a fund manager is you're not necessarily paid for your time. You're paid for taking good decisions. So if you get it right, no one cares if you've taken that decision in 10 seconds or 10 days. Obviously, to arrive at a good decision, you do tend to have had to do a fair bit of analysis and done your background reading. But I think naturally that creates an industry just by the nature of how the work sort of works. It naturally creates an environment where it's not so much about working up against a very tight deal deadline that has to be closed at 4 a.m. or something. It's just a different culture. I would be interested actually to hear what the culture across different companies is, because I've actually only ever worked at Schroders, so I only know the culture there. But I would say the culture there is all about building up their people and the skill set of the people. And it's not a FaceTime culture. It's about sharing ideas with each other, debating ideas with each other, and trying to encourage each other to be the best that they can be.
That's great, Tara. Thank you. Yeah, I think it's a really good point to say that in this industry, you're not paid by the hour because it is not a transactional industry. It is a judgment-based industry where the outcome of your judgment is only known in the future. And so this is requiring patience and humility, but the trade-off is that you're not really on the clock against a deadline to close the deal. And speaking as a former investment banker, I can say that's a significant difference in both culture and the work-life balance. I'd love to hear from others as well. Shivani, how do you stay on top of news, and how do you get your peaceful sleep?
Yeah, absolutely. So I think Tara touched on a lot of the points, but I think from my perspective, there's 3 key areas in terms of keeping on top of news. One is having to be selective in terms of what is important and what matters. So what kind of economic data are we really interested in versus kind of what's just noise. So we're very selective in what we actually track and discuss. And that doesn't mean that can't change over time and that we haven't missed things as a result, but we keep refining that process in terms of what we care about and what we discuss with each other. And then kind of thinking a little bit more thematically, we kind of divide that up amongst the team. So for example, someone on the team might monitor specific news within the healthcare sector, someone else within decarbonization as a broader theme, others within, you know, European startups, and we share articles, we share developments in those sectors all with each other, mainly through we use Slack, which is kind of a work social media tool. So that's one aspect. The other is paying for research, which again, Tara talked about, but there's lots of firms out there that produce very high quality research that we can rely on to inform our investment decisions. And then the final aspect is there's increasingly some good tools out there that leverage AI and machine learning in order to track news flow for again, what's important to you. So for example, for some of our underlying portfolio companies, so the companies that our fund managers are invested in, we can track some of that news using this AI software, so that we're not trawling through news or doing Google searches every day, but this kind of springs up to our attention. So there's some really kind of clever and useful innovation out there. That's an important part of what we do as well.
That's fantastic. Well, I'll throw my support behind a daily sort of free newsletter called Morning Brew, which is a very quick espresso-like overview with some fun facts and sort of the essentials of what you need to know even before you open the Financial Times. And, my young nieces introduced me to that. So this is a very 20-something piece of financial journalism. Let's move on to Bertie. How do you stay on top of news and get peace of mind?
Yeah, I was going to say I also read Morning Brew and Finimize particularly, which I really like as well.
Yes.
Really good bite-sized news, so really helpful. For us, I mean, obviously our world of news is a lot more narrow because it's focused on real estate and European real estate. So we have a bit less material to go through. The way we do it internally is we have a very strong research team who basically do all of the heavy lifting for us and put together really helpful slide decks. We have monthly meetings with them where they kind of go through all of the market dynamics and everything that's important to us. So in terms of macroeconomics, they do all the work basically and deliver it to us in a very digestible fashion, which is great. What we do track, all of us, is more like the transaction flows and what's happening in the market, who's buying what, where, how much people are raising, how much money they're raising, what new funds are out there, etc. And for that, we do pay some news providers who create, really good content, and we just get their newsletters, say daily or weekly, in our inboxes, and it's really, digestible, bite-sized, and really easy to go through. So yeah. That's mostly how we do it.
And what do you read personally? What is your personal way to stay up to date and informed on things that you care about in the financial industry?
So yeah, Morning Brew, Finimize, definitely my two first reads in the morning. And then I love BizNow in our industry is great. It's basically every morning around 8:30 they will send you an email with a bunch of links of what's happening in the market, who's buying what, who's doing what are the different trends, etc. So I definitely read that every morning as well. And then in terms of more global news, I love the Wall Street Journal. So yeah.
Excellent. And by the way, I hope that all the students out there know that they have free access to the Financial Times through your school. I'm not sure until which year in school, but I know that for most universities, there's free access. I'm not sure about the Wall Street Journal, but there must be some sort of a
I started reading the Wall Street Journal because my uni was giving us that. So, but that was
I'm pretty sure that's available. So definitely explore that. Ollie, what do you read?
Yeah, I actually read a lot. And I think that's because I'm focused on so many different funds and so many different products. I try and keep up to date with certainly as many of them as you can. But I think the key with reading is you're never going to read everything, and you just can't read everything. And almost, I would say, don't try to. I think that's the key. What we've been very lucky with, certainly when I was at university, was I actually found things like the Financial Times quite intimidating. You know, got this orange, very professional looking newspaper, and you don't really know where to start with it. What's really nice about how things have developed, certainly over the last, I would say, 5 or 6 years, is that things have become a lot more bite-sized. So I'm very glad that Batil is or listens to Finimize, because actually that was set up by one of my friends at St Andrews. So Max has done a great job with that, and it was actually recently sold to Aberdeen. So that's a great tool that I think you can use. In terms of what I do personally, I read a couple of things in terms of the actual markets and what I'm listening to or reading daily. I read something on the Financial Times, which I think is great, and I think it's a bit of a secret that not many people know about, but it's called the Global Markets Overview. You can read that. It will take you probably 5 minutes, and it tells you everything you need to know that's going on. Not everything, but it's a good place to start. So I always read that. That kind of pulls out all the kind of big topics that are going on. It's pretty layman terms, so it's a pretty good thing to read. Another thing, if you're not into reading, or you want to listen to something on a run, or you know, as you're commuting perhaps, or you're walking to lectures, I actually subscribe to, and it's free on Spotify or on other podcast providers, the FT News and Morning Briefing, which again I think is great. That's about 10 minutes. You can listen to that. I think that is almost a slightly condensed version of the Global Markets Overview, but a great thing to listen to. I do a lot of reading outside of what I'm going to call markets, that market reading. I think that's really, really important, just to give yourself a very broad and well-rounded knowledge. But I also think, and I was just thinking as other people were talking there, that sometimes the best investors in the world have actually removed themselves from what I'm going to call noise and almost reading too much. So if you look at perhaps the most famous, Warren Buffett, he actually bases his company in Omaha. Now that is not London, it's not New York, it's not Singapore or Hong Kong. This is somewhere that is quite removed from news. And I think that's quite telling. People, I think, can almost become paralyzed by too much information. And I think it's important to know that you're never going to be able to read everything. So don't try, just be quite specific and centralized on what you do.
That's great. Thank you very much. I totally resonate to that. I think when you start out in the industry, you tend to sort of swim in the big ocean of information and news. And it's important, you kind of marinate in all of this information and knowledge for a while. And then you have to figure out sort of where you need to swim, you know, where you need to be on top of the water and be able to look below you and know that, you know, you're in the right place. So I think that filtering process comes over time. And in the beginning, it's really useful to read sort of the newsletters, the financial press. The Economist, I would argue, also is really important in that, is that it gives you frameworks and terminology. And it also gives you a diversity of opinions so that you're not just sort of stuck thinking about things the same way. And we have some other very pertinent questions that tie into some of the questions we discussed with the panelists before getting on the call. How did we all end up here? What were the education and vocational choices that you made that brought you to this career and to the role that you are in now? So let's start maybe again with in the same order with Shivani.
Yeah, so I studied PPE, philosophy, politics, and economics at Oxford. But what I would say before I go any further is that everyone on my investment team has studied a huge range of subjects. So we have someone who did chemistry, someone who did classics, someone who did Oriental studies, someone who did history. So it's by no means necessary to have done something that you see as vocational or something economicsy or maths to get into this. You can come from pretty much any background as long as you have the interest. But in terms of how I got into it, I knew I was interested in finance, but I knew it was a huge industry, and I didn't know kind of specifically what part was interesting to me. But over time, I realized that asset management, investment management was what was most interesting to me, because I felt like it would be most intellectually stimulating to be able to choose where to allocate money, what long-term themes to back, that sort of thing. And going to the Oxford Endowment Fund was particularly attractive for a few reasons. One was because of the mission. So ultimately, all the returns we make go back to funding the research and educational grants of the university, which is fantastic and very motivating. The second is that it has a really long-term, being an endowment, we have a very long-term investment horizon, going back to the conversation about investment horizons, which means that we have the ability to invest in quite interesting long-term themes and areas and asset classes. So for example, we can back really young emerging companies that could one day become the next, biggest company in the world one day, or could be, the biggest solution to climate change in future generations. So we have the ability to invest our money and then wait for those things to transpire, which is a great position to be in, and gives us huge scope for being able to invest in many different areas. And then the thing I liked as well about Oxford was that it was a small investment team, and every business really differs in terms of how big the teams are. But I really liked that because it meant that all investment decisions were discussed or are discussed as a team. We're very collaborative, very collegial. We reach decisions together. Obviously, our chief investment officer does have the final say, but it's great to be part of a team that even when you're 21 joining out of university, you have some input, and people listen to your views around the table, and it's a great way to learn as well. So that's how I ended up there.
Fantastic, thank you. Some people in the chat have asked, if you don't have previous experience in finance or economics and you're in your last year of studies, are there courses you should take, or is there a book that you should read? If you're just starting to think about it and you haven't had the background academically.
It really depends on in terms of what area of finance that you want to go into, because otherwise you're kind of boiling the ocean a bit. I think there's some really good resources on Gain's website that I would point people towards, and depending on what your interests are, whether you are more interested on the company side of things or real estate or everything, you can find resources there. But I think in terms of general reading, I think some of the resources that we mentioned just now when we were talking about news are great, because I think staying on top of current affairs is important to pretty much every aspect of investment management. So I'd say doing that, listening to podcasts as well, such as the Morning FT one, which is great, will keep you up to date and up to speed with the latest trends. And then in terms of kind of deeper reading, that, as I say, that just depends on your area of interest, but take a look at Gain's website.
Thank you very much. We certainly appreciate that vote of confidence. And Bertie, over to you. How did you get from Paris to London investing in real estate?
Yeah, I mean, as most of us will probably say, I had no idea I'd end up here. When I was in high school, I probably would have told you that I was going to become a doctor or an engineer. Then I decided to study hotel management out of all things. And so I moved to the Netherlands and studied hotel management over there. And so, as Giovanni said, I had absolutely no education that relates to my job right now. I've had nothing. So after my studies, I moved to hotel real estate. I started working at a company called JLL, which was essentially, my team was a hotel agency. We would sell hotels to investors. And after that, I came across Heitman, and coming back to the culture point, I was really attracted to the company because of its culture. And then also because I wanted to kind of learn a bit more about different real estate asset classes and be on the investment side. I really wanted to be in the action and really, get to know the investments, really manage the money, and not just sell and then you're out of it and you don't know what happens with the investment. So yeah, that's how I joined Heitman. And I think, you know, I had, as I said, I had no background whatsoever in finance, but I really learned on the job. I think it's really important. If you're really adaptable and you're a quick learner and you ask questions, then, you know, you'll learn on the job, and people will train you. If you're just out of uni, it's, you know, it's also a bit of entrepreneurial learning. I've, you know, sharpened my Excel skills outside of work as well, because that's a really important thing to have. And yeah, reading a lot and asking a lot of questions, as Ollie mentioned earlier, is really important. So yeah.
That's excellent. Thank you. Thank you very much. Now, Tara, over to you.
Thank you very much. Yeah, so I actually also came from a background that wasn't related to finance particularly. I studied a course called Natural Sciences at Cambridge, and my natural sciences basically starts very broad, covering all sorts of sciences, and by the end you have to narrow down. So my major focus by the end was chemistry. And the way I tend to explain it to people is, I don't think I use the exact subject matter knowledge that I learned at Cambridge in my job day to day. But what I definitely do use are the analytical skills that I learned there, the mathematical skills that I learned there, and the way I also learned to learn. I think it's an attitude thing and how you approach things. And I think what you learn at university is how to go out there and ask questions, how to teach yourself things, how to be naturally inquisitive about things. Because it is at university a lot more self-driven learning, I think, than what I certainly experienced at school. So not an economicsy background, but I did always have an interest in finance, if I'm honest. I wouldn't say this to the person who interviewed me at Cambridge, but I obviously managed to pull the wool over their eyes and convince them I wanted to be a scientist at the time, but I never had any intention. I think the reason is that careers in science can be quite challenging. They're obviously hugely interesting and rewarding, but I wasn't sure that it would actually suit my personality type. But the reason I didn't want to do economics at university was that I just thought it would be interesting to go and do something else for a little bit. I thought I'll probably end up doing economics or finance for the rest of my life. So why not go and study something slightly different? So the way I got into the industry is I actually applied for an internship at Schroders when I was at Cambridge. And my first experience at Schroders was actually in a distribution and sales role. So probably a bit more similar to what Oliver's now doing. And that was actually a really fantastic learning ground. I think that the major advantage of working in a sales team, which I think Oliver alluded to as well, is just the breadth of clients that you get exposure to and the breadth of the business that you get exposure to. So in a role like that, in a company like Schroders, which is very big, you get to see what all the different investors are doing. And by the time I realized that actually thought I was more suited to a more market-facing role, I had a base level knowledge in most of the areas of the business such that I could take an educated decision on what I thought would suit me in terms of an investment style. So the first move I actually made onto the investment side was onto a team that basically runs investment strategies that are quite systematic and algorithmic. So you kind of design ahead of time based on all sorts of maths and science, what algorithm your investment strategy is going to follow. So if X happens, we'll do Y. We tend to kind of call that systematic or non-discretionary management. So I did that for about 3 years, and that was a really good way to get to know market dynamics and get to know what people trade in the market and how things behave. And after about 3 years there, I thought, do you know what? I think I'd rather be taking active decisions on where to allocate money. I wanted to move from that sort of scientific approach to more of a judgmental approach. So that's the point at which I moved over to the multi-asset team at Schroders, and that's where I still am today.
That's great. Thank you so much, Sarah, and leading straight into Oliver, and I think your very interesting path to your current role as well.
Yeah, sure. So I think a common theme here is that we didn't know exactly what we wanted to do, although Tara, it seems that you were pretty set from the beginning, but you came from a pretty broad background and kind of went down the science route. Certainly for me, when I was at university, I wasn't exactly sure what I wanted to do. I knew what I was interested in. I think the big thing for me at that stage, whether I was in my first, second or third year, was that finance seemed quite narrow, as in you could only go and do one or two jobs within finance. And I think the big thing that you have to realize, and I think it's really important to realize, is finance is one of the broadest sectors I think you could possibly go and work in. Hopefully this call or this Zoom is giving you some idea of how broad that can be. So you can go and work on the client side, you can work on the sales side, you can work and make some investment decisions. So it's incredibly broad. I think I was very lucky that when I was at university, the societies I was part of, the people I mixed with, the talks I attended, and I was very active on that side of things. They kind of guided me in a way to think that finance was going to be something that I was very interested in. I was also very lucky that I attended lots of internships, and I think that was a really good hunting ground for me to kind of decide exactly within that broad remit of kind of where I'd go and where I'd end up. So I actually interned at HSBC, Barclays, and RBS. Now, just to kind of alleviate any kind of fears there, I didn't have any help with that. My parents, actually, my dad was a teacher, my mum was a stay-at-home mum. I didn't have any help in terms of securing those. So it was really a case of me looking myself, or in some occasions, I just call people up, and perhaps that was like a precursor to me getting into sales. So I just call people and say, hey, do you offer an internship or do you offer work experience? So that was really helpful for me to kind of decide where I wanted to go. I was very, very lucky that when I was in my last year of university, a company came onto the campus and was looking to recruit some graduates, and I, as part of that, attended an assessment day and then joined back in 2010 as a financial analyst on the North American equity desk, actually covering home building. So I was looking at the kind of home builders in the US. I did that for about 18 months, 2 years. And perhaps unlike Tara, I just decided that was not for me. You know, it was really intense. I ended up spending a lot of time looking at spreadsheets, and I thought, is this really what I want to do? Is this what I really want to do kind of for the rest of my life? I equally thought, very honestly, whether I could become the best analyst. I just didn't think I could. So at that stage, I pivoted and went onto the sales side. I was actually offered a role in the kind of client-facing position at the same firm. And they said, we think you'd be great. Why don't you come and learn about this side? And so I did that and haven't looked back since. The one piece of advice I would give is, always remember that the finance world is incredibly broad. There's loads of companies. You know, it's not just Goldman, JP Morgan, Barclays, Citi, HSBC. You can go and work at companies you might have never heard of. And I'm sure there won't be many of you who have heard of PineBridge. I mean, PineBridge is a 140 billion asset manager, but you might never have heard of them before. I hadn't, until I got until I got the call. So you can always work at lots of different places. That's the first thing. And the second bit is, I think it's quite interesting to go and join quite a small company, because you get a lot more, I think, knowledge, you get a lot more exposure to quite senior people. And I think you get more opportunities. So don't always think that you have to go and work at what I'm going to term the kind of bulge bracket banks or bulge bracket firms. There is lots of opportunities, lots of different firms. You'll get a great knowledge, you'll get a great education. And that's certainly helped my career.
That's great. Thank you so much. I'll maybe cap it off with my own story, and it very much resonates to what everyone else has said, except that I can add a couple of decades on it. So when I was graduating from college, the Berlin Wall came down and the Soviet Union dissolved. And I thought, wow, well, this could be interesting, because I majored in international relations and I was at Georgetown University. So I was in Washington, D.C., thinking like everything's opening up. This is so exciting. And Madeleine Albright was my thesis advisor. And so I first thought that I should go straight into sort of, State Department or sort of public service side of economics. But then I realized that the really exciting things are happening at the level of businesses. And that has really stayed with me throughout my careers. As much as I think it's important to have good governance, good policies, and I'm always very interested in foreign affairs, it is really businesses that build bridges between countries, and that really made a dramatic difference in the economic outcomes of Eastern Europe and the former Soviet countries. So I wanted to get involved in that, and the fastest way was frankly through investment banking, because it was the intermediaries that were helping to channel capital from companies in the West to companies in the East. And to Oliver's point, I didn't go straight for the big name firms. I actually went to work at a very small firm, which at the time had occupied just one floor of a very plain building on Park Avenue, and that was the Blackstone Group. And Larry Fink and Stu Schwartzman were sitting on the opposite sides of the corridor, and we're running around figuring out like who's going to pitch the deal. And after that, I worked at JP Morgan, more specializing in emerging markets, because that's when I realized I really want to go down in this direction, whereas Blackstone stayed much more sort of generalist. And it was only in business school that I discovered there's this whole field of investment management. And I think it still is a fairly opaque field if you're not inside the industry. And had I not been cold called by a professor who really wanted to put me in the spot for questions about privatizing assets, that were formerly in communist countries, I would have never even perhaps realized that this is something that I could be good at. And that's what you have to really think about as you finish your studies is, what is your skill set? What are you good at? Are you good at analyzing, or are you good at sort of doing things? Are you good at numbers? I'm not particularly quantitative, but I'm very numerical. And that's important. If you're going to finance, you have to at least like numbers, and they have to make sense to you. The world makes more sense to me when I have some numbers around facts. And so I felt comfortable reading annual reports, and I felt comfortable reading financial disclosure statements. And I particularly liked meeting management teams. And in my role as an active investor, you do get to meet a lot of companies and a lot of management teams. And using that judgment as well is really an important part of the investment process. And again, that's something you have to like or not like. If you are not into the sort of the people thing and asking lots of questions, well, there's passive investing. And there was actually a question we're going to get to going forward on the future of the fund management industry and the future of the value chain of our industry as it gets disrupted by fintech, as it gets disrupted by different kinds of investing styles, including passive. So in the time we have left, why don't we actually go now through this sort of forward thinking question as to how could our industry change and how could your job be different given these new developments? Maybe Shivani, we'll start with you. You mentioned also AI and something that you use in how you stay on top of news flow, but what else is happening in terms of the technology and innovation and disruption that's making it different for you now and might make it much more different 10 years from now?
Yeah, I think one key thing is that the sort of investing I do is fundamental investing. So we've talked about it in detail, but effectively choosing companies based on doing the micro analysis of their financials, their management teams, all that sort of thing. But another form of investing that, well, it's been around for some time, but increasingly kind of accelerating is quantitative investing or systematic investing, which is investing based on building mathematical models to predict the direction that a certain stock, for example, will go, versus doing the fundamental analysis on the company's earnings and that sort of thing. So that's becoming it already is quite a big industry, but it's becoming increasingly bigger and bigger. So there's that will bring disruption to the traditional, or is bringing disruption to the traditional fundamental investing space. But then that creates opportunities for people who are interested in that aspect of investing. So if you're very mathematically minded, if you study computer science, if you like coding, it's a very interesting area to get involved in, and I think it will continue to be a strong competitor to fundamental investing as well. And then the other thing, kind of more broadly, is the themes, investing themes that we look at are constantly evolving and changing with new technology. So 5 or 6 years ago, we didn't talk about cryptocurrency, crypto assets very much. Now it's something that we talk about almost on a daily basis. So emerging trends like that suddenly mean that your focuses in terms of what you're looking to invest in, the kinds of fund managers that you're interacting with, that all changes over time with the emergence of new themes, and new themes are always coming about, as we move through time. So that's an exciting part, I think, of investing, is you're never focused on one thing. It's constantly evolving and changing as the world changes, and investing is always reacting to that. So I think it's a really positive aspect.
That's fantastic. Thank you. Bertie, what do you think?
I think for us, the biggest driver of change right now is what we call ESG, which is environmental, social, and governance.
I knew we'd get to it.
Yeah, we had to. And for us, it's, it's all over the news, in every conversation. It's essentially the built environment has a huge impact on the environment, and it's a big problem. And we're all trying to tackle it, whether it's our peers, our clients, everybody along the value chain is thinking about it. And so we're all trying to figure out how to do it, and what to do, really. And I think it started just before COVID started. I would say that it just became the center of conversations, whether it's with investors who want to invest in our funds and they want to make sure that we have a solid plan on how to mitigate our carbon emissions, to talking with our colleagues, to talking with the sellers of the properties we're buying, etc., etc. So at Heitman, we have committed to being operational net zero by 2030. So we're working really hard on how to do that, right? We committed to that, and we are looking at a bunch of different ways on how to decarbonize our assets. So our plan for now is to start by improving the energy efficiency of our buildings as much as we can. So that means insulation, double glazing, refurbishments, changing gas boilers into electric boilers, these kinds of things. The second step is installing on-site renewables, so solar panels, these kinds of things. And then the last thing will be to procure green energy. So make sure that all of our electricity comes from either wind, water, or any kind of renewable power, solar as well. And then the very last thing that we hope we don't have to do, but probably will have to do to offset the last bit of our emissions, is to buy what we call carbon credits. They're quite controversial right now because people will tell you that for the number of trees that people have pledged to plant, there will not be enough space on the planet by now. So there's a lot of controversy around that, but we're trying to make sure that we invest that through our offsets, we invest in really local and proper initiatives. So that's the plan for now. I think one of the main challenges, and that touches on the whole AI and technology point as well, is collecting data and analyzing data and processing data for all of our properties. And everyone is working really hard to figure out a good solution to do that.
That's great. But, I tell you, this is a global phenomenon for sure. And even in frontier markets, it's as relevant. I'm on the board of a real estate investment trust in Morocco, and we spent the past year basically finalizing an ESG strategy, having an impact report. EBRD is one of our shareholders, as is the South African pension fund. So it's really important to them as stakeholders. And we're building the first sort of eco-certified building in Morocco. And it's really hard work.
Yeah.
So I definitely resonate with what you're saying in terms of like the physical assets. It's much more rigorous than thinking about ESG from a portfolio level, which is sort of the lens that I had used before. Thank you for sharing that. Tara, what about you?
Really good ideas already being discussed. I think, those are definitely two very topical areas, and I definitely encourage everyone to go and sort of have a little background read about those two. They probably would have been one of the two I would have commented on first, so I'll think of something different. And I think probably one big change actually since I started in the industry is the amount or the extent to which big data is being used, and trying to leverage what we'd probably call quite alternative data sources. And I'll give you a little anecdote to try to kind of bring that to life. But we have a department at Schroders, which is called the Data Insights Unit. And I think the COVID pandemic has really brought that team into their own, in that they've been able to provide us with some really valuable insights into what's actually going on with the pandemic. So I think one source that would be open to everyone, which I'd never looked at before the pandemic, is something called Google Mobility. So that's a data source that tracks how much people are moving around. It's basically looking, I guess, at satellite data and seeing whether people are traveling to their workplaces, whether they're traveling to retail sites, or whether they're just pootling around their own neighborhood. And that's what I would call an alternative data source, because it's not really market prices, it's not companies' earnings, but it's looking at behaviors and how people are acting to try to then take a judgment on what might happen with the economy. So that's one example which is publicly available, but the team we have obviously tries to develop their own types of data sources like that. So I think big data would be my theme of, investment decisions being made off slightly alternative sources now.
That's interesting. Thank you. Ollie, what are your thoughts?
Yeah, so I think the great thing that we're seeing today is this path on ESG. And I think what it shows you more than anything is that the fund management industry is amazing at creating products out of themes. And I'm sure that both Shivani and Tara, you will see so much coming your way in terms of ESG, whether that's funds within a multi-asset portfolio or whether it's ESG specific funds for Oxford Endowment. I think my view is twofold. I think we'll see a huge development in ESG, whereas I think almost ESG, what we call ESG integrated funds, will just become a part of the course. I think what you'll see now is a greater focus on things like impact investing in liquid markets. Equally, we believe at PineBridge that there's going to be a complete decoupling of ESG, so that you might instead have funds that focus on environmental, you might have funds that focus on governance, or themes that are within ESG, so healthcare, obesity, things like that. So that's the first thing, but never be surprised how good the fund management industry is on creating products out of themes. You'll be able to see that in terms of crypto assets and things like that. The other thing that is probably most relevant to what we're doing at PineBridge right now is the idea that, or the change in where private equity and a lot of these alternative investments are being made for the wealth market. And so turning typically quite liquid vehicles into more liquid vehicles. And what we mean by that is typically private equity is in a locked up vehicle where you can't buy in and sell that product on a daily basis as you could do a normal equity or bond fund. So what people are trying to do now is create a more semi-liquid or quasi-liquid vehicle. Now, I completely understand that I'm giving you loads of jargon here, so don't worry about it too much, but it's a theme that is happening now. And I think what we'll see is that a lot of those kind of alternative investments become a lot more widely bought. They're not just going to be bought by institutions that can lock their capital up for a number of years, but intermediaries like those that I deal with, or the wealth market. And I think what you'll see is individuals and high net worth individuals starting to buy a lot more of these alternative investments. And I think that's something that is quite difficult from a structuring point of view, but it's something that is certainly gathering momentum, and something that we're focusing on at PrimeBridge.
That's great. Thank you. We had some really interesting and varied points of view. I'll throw mine in. I think there is going to be real tension around active and passive investing, because passive investing allows so much more customization and sort of personal thematic investing opportunities that the retail investors seem to really like. So there's a great sort of bifurcation of investment styles right now, where you see passive funds, which someone asked in the chat exactly what they are and how do you invest in a sector. They're essentially an index. So if you were to invest in the automotive sector, you would essentially buy one share of every automotive company out there, in weights that basically reflect their current market capitalization. And the structure of the index is rebalanced every quarter or so, and reflects the market moves. So there is sort of that aggregation aspect of passive, but there's also a real thematic aspect of passive. So you could, for example, construct a fund with just the ESG leaders. That would be a backward-looking assessment on what companies are highly ranked on ESG criteria today. And as you see from the capital flows into funds over the past sort of 18 months, they're very, very popular. Is that an effective way to invest in ESG? I'm not sure, but I think the customization aspect really appeals to certain kinds of investors. And this is just from an institutional perspective. And then when you go to the end of the spectrum, that's retail, and the rise of Robinhood and the rise of, sort of personal trading apps, people like to punt on stocks, and certainly stocks that have brands or some kind of a social narrative that people can relate to, but they also really like to invest in a theme. And you can see with the ETFs, how much that has taken off. Again, I'm not sure it's a good thing, because you can have some pretty bad ideas behind them, but it certainly is a democratization of access to investing through very different flavors of vanilla. And it all does seem to favor flows into passive funds. Now, why is that a problem? Why is that disruptive? Because passive funds are price followers. Remember, they are investing in shares based on how they did yesterday. They're not forecasting how shares will do tomorrow or 3 years from now. So the price setters are active funds, and we're seeing outflows from those funds. The price followers are passive funds, and that's where the flows are going. And now I think in the US, it's about half the volume traded. And if you look at the large companies and who their largest shareholders are, for the most part, the top 3 or 4 largest shareholders will be passive funds, which means that their decisions are based on how the company had done in the past, and they don't really have any strong conviction in terms of investment conviction going forward. The company management is not meeting with analysts who are experts in this field. They're meeting mainly with their stewardship people, who are very important, but they're not specialized in understanding and helping the company understand their competitive environment or give feedback on their strategy. So it changes the dynamic there as well. And someone asked in the chat, what is more important, fundamental assessment or technicals and momentum? The answer is it depends what you're investing in. If you're investing in an active long-term fund with the objective to have capital appreciation over a market cycle or more, then of course you're looking at fundamentals. But there are other kinds of funds that will look at momentum and technicals much more closely, especially, actually, as Tara mentioned, some investors really want that tactical risk management, and sort of 6 to 12 month return visibility, right? And as Oliver would say also, some clients really want to have very tight parameters and constraints on what their risk return profile is. And so you would have to take those factors into account. But I guess I would say that in the next 10 years, there'll just be much more of that dispersion of products and tools that hopefully policymakers will be able to regulate intelligently to allow creativity and innovation to drive capital markets, but protect retail investors and protect individuals from making sort of poor investment decisions. So we have just a few minutes left. We have 4 minutes left. I think we've covered the questions in the chat for the most part. Just to close up, I think it'll be fun if we go around the panel and ask each of you to give just one piece of advice to our audience in what matters the most in understanding the industry and how to go about taking the next step. Can I start with you again, Shivani? You've been very, very kind to kicking this off.
Sure, I'll start. And Ollie's covered this a bit before, but it definitely resonates with me. And it's what I noted down at the start, which is ask as many questions as you can, right from the start. No question is kind of stupid or anything like that. There's so much jargon and it's so easy. I used to think, like, how can people just a few years ahead of me who started a job a few years ahead of me have forgotten what it's like to not know anything and be using all this jargon? And then I realized now, 5 years in, that I'm doing it myself. So you get kind of sucked into it, and people forget how you come in not having been exposed to that at all. It's a completely different world. So just ask at the start, or as you go, as you move through your career, constantly ask questions, because that's the only way that you'll learn.
Very good advice. I still ask questions 30 years on. Befti, what about you?
Yeah, Shivani stole my advice, but so I would echo that definitely. Be curious and try to learn as much as you can from people around you. And I think one piece of advice that I would give is get mentors around you. That's very important, and that's something that early on in my career I found very intimidating. But there are loads of programs, especially for women these days. A lot of really good mentoring programs. And it's not just about formal mentors, but it's also about informal mentors. So yeah, mentors is definitely a big piece of advice that I would give.
That's excellent advice. And to be honest, many of my mentors have been men, and you should not think of, reaching out to just women for advice in your career. Men have been, some of the most influential, positive factors in my professional development. So that's great. Thank you. Tara.
So for me, I think it's all about attitude and willingness to kind of show your personality as well. And I kind of think back to recently, I was actually hiring a new graduate, an analyst, onto the team. And I said to my boss, you know what, I really don't care what they know. I just want to know that they're going to come to me with a positive attitude, that they're going to be willing to learn, they're going to ask me lots of questions, and they're going to take new information on board and not be afraid to show their own flair, to show what they're interested in. And I would say finance isn't necessarily a sterile environment that it's portrayed to be amongst many people. You don't have to fit a particular mold. Find what you find interesting and show to everyone else that you are really interested in that, and don't be afraid to do it.
Great advice. Thank you. Oliver.
I think probably coming on from that answer, I think my one piece of advice, and I think we've had some amazing bits of advice here, but I'd say try and do something that you love, that you find genuinely interesting. So I think that's the first and foremost. I'm very lucky that I've got quite a few mentors around the industry, and actually met one last week, and they're saying to me that the world is always looking for greatness. If you do what you love, greatness will shine. I think that's really, really important. The second thing is, and it's something that I instilled in myself, is be really honest about what your skills are. Try and think about your personality and think about your natural skills, and don't try and shoehorn yourself into a career that perhaps isn't not exactly suited for you, but suited to you and those skills. And I think that's really important. So that's what I've always tried to do. But yeah, get yourself some mentors, ask loads of questions, do what you love. I think they're fantastic answers.
Excellent. And of course, my advice is to definitely stay a part of GAIN. We hope to provide you with lots of tools and events and mentoring opportunities to deepen your knowledge about investment management, and also increase your interest and access to internship opportunities and learning opportunities, etc. I also think you can find a ton of great information on LinkedIn about specific investment firms, about specific investment styles. And some very accomplished investors like Howard Marks and Ray Dalio, they basically now run blogs, and they're really good. I actually read them and enjoy them tremendously. So keep feeding yourself that sort of intellectual nourishment to figure out if you love it, and get used to the terminology and see what different people you meet, because this is truly a very diverse industry, and we'd love to have more women in it. So thank you very, very much for spending this time with us. Thank you so much to the panelists. You're outstanding. I really enjoyed our discussion, and I hope we meet again soon. Thank you to all. Have a lovely evening.
Thank you.